And if a run starts on the banks, and again, we already had one, which happened during the last, people get nervous and go pull it out. And we've seen it. We've seen over $30 million from our clients take it out of banks and then give it to us to guarantee interest rates for longer terms than they were getting at the bank.
Here's a headline from Cryptopolitan. U.S. banks' unrealized losses soar to 7 times 2008 crisis levels. Well, so a chill runs down my spine when I see a reference to 2008. We all know how bad things got economically, 07, 08, 09, and in the wake of that. 7 times worse. What's going on, David?
All right, so first let's go back to that time period. You had over 50 banks go under. But the asset total of those 50 banks in the 08-09 that went under were less than the 3 main banks that went under just 2 years ago, Silicon Valley Bank being the biggest and the first that went down. Well, just this past weekend, we had a bank just south of us in Lindsay, Oklahoma, go under, and the Fed comes in and takes them over on a Friday. Just so you understand, if you're under the deposit limits, the FDIC insures your money, et cetera. But we can expect several more of these to happen. And when I sent that article out, which is almost a week old now, I kind of was telling you guys, look, Treasury, every time Treasury rates go up 10 basis points, it's probably another bank failing. Well, Treasury rates have gone up 15 basis points since I sent you the article. We crossed over as of this recording. We're now over 4.25 yield on the 10-year Treasury. The higher that yield goes, and if you remember, when Treasury yields went up a couple of years ago and the Fed started raising, that's what created the banks to fail. Because what happens, Chip, is, and we've got a chart to show how much unrealized losses are sitting on the major banks in the U.S. today, and it's 7 times, as you mentioned, 7 times larger than the losses occurred during the Great Depression.
Let me ask you to define a term here. What is an unrealized loss?
All right, so if they were to sell the asset, they would lose money. Just like if you own a stock and you're down, you have a loss, but it's a paper loss until you actually sell the asset, right? So it's not a real loss until they actually sell it. So, of course, then the argument is, well, then they'll just hold it to maturity. Well, that'd be great, Chip, if they could. But you got to understand the way banks actually work. They make money off what's called net margin spread, right? So they take your money. They don't stick it in the vault and wait for you to come and ask for it, because they wouldn't make any money if it's just sitting on the vault floor.
Well, they're putting it out there and using it.
So they're buying assets. They're making loans. So these assets, which are typically loans, are what's underwater now. And it's heavily in the commercial real estate space. As we know, commercial real estate, and we talked about it for the last 2 years, all the buildings that are selling for 10 or 15 cents on the dollar. So the value of the loans are significantly handicapped. And again, if they hold to maturity and the person they lent the money to has the ability to pay, then all things are good. But what happens if you say, you know what, I'm cashing out my $500,000 in CDs at your bank, I want my money? I want to tell you, there's very few branches you can walk into that have $500,000 in the facility. Most this might shock people, have less than $100,000 cash in them. Most banks that are on the brick and mortar have less than $100,000 of actual cash in any one location.
I'm seeing a vision of It's a Wonderful Life in my mind.
Exactly what's going to happen.
Building and loan we don't have all of your money just stacked up here. It's in Joe's house,
Betty's house, Joe's house, et cetera.
Yeah.
And that's exactly what happens. So if you go and if a run starts on the banks, and again, we already had one, which happened during the last, people get nervous and go pull it out. And we've seen it. We've seen over $30 million from our clients take it out of banks and then give it to us to guarantee interest rates for longer terms than they were getting at the bank. And they had us buy T-bills. Some of them bought guaranteed fixed annuities with interest rates backed by the insurance carrier. So we've seen people make that move over the last couple of years. And imagine that across the entire country. We're just one small financial advisory shop in Omaha, Nebraska. So multiply that across the entire landscape. If people get nervous and Treasury yields keep going up and you're not getting paid anything in the bank, what are you going to do with your cash? If you're blessed to have it, you're going to move it where you're going to get paid. And by the way, we can still pay you 4.35 interest, on your money, money market, FDIC insured up to $5 million every day. So if you're not getting that, at least, then you want to find out, you can reach out to us. But anyway, the problem is there's going to be more bank failures. And on top of that, and I think I sent it to you, and I don't know where we may cover it later in the show, but a couple of the biggest investors out there in hedge fund land have now shorted the Treasury market to vast numbers. So Stanley Druckenmiller is now 20% of his entire portfolio is short.
We have a question about that in our Q&A today.
Okay, so I'll save it and talk about it there, but I'm telling you where the smart money is going is telling you that interest rates are going higher in the near term, not lower. And again, that comes back to inflation. The bond market is kind of sticking their tongue out at the Federal Reserve, who tried to influence rates going down? I mean, that just brings up another simple discussion. Does the Federal Reserve control interest rates? The answer is simple: no. The Federal Reserve controls the Fed funds rate, which is the overnight rate you pay to balance your books at a bank when you go to the Fed window, because you have to balance every day, which is, by the way, why banks used to have to close at 2 p.m. because they had to tally everything up every day. You had to have your books reconciled by the end of the business day. So now if there's an imbalance, they simply are allowed to borrow at the Fed to kind of make their balance sheet work every day, and these transactions happen daily. Now we're actually paying banks to deposit money at the Fed, which the Fed is losing money. We talked about that on the show recently. So the Fed's losing an astronomical amount of money, but the Fed can influence rates. So they lower the Fed funds rate, lowers the discount rate. So that has usually an immediate impact on banks for credit cards, right? So those are the rates that they can change: money market rates, short-term signature loans, even HELOCs. But the further you go out on the length of a loan, the less influence the Fed has. In other words, if you were to borrow an 84-month car payment, it's going to have some effect on the car loans rate, but nowhere near as much as if you were on a credit card, which is every month, right? So it can change. Then you look at a mortgage, a 30-year mortgage. Yes, it affects it, but very little. And so the further you go out on the duration of the financial instrument, the less effect the Fed can control it. And the 10 years, what we base most of financial instruments off of today, mortgages, et cetera. It used to be 20 and 30 years, but really the 10 years really what we watch. And again, that has gone up. We've seen mortgages go over 7%. The Fed cut 50 basis points. Everyone thought it would be down 100 basis points. Instead, it's up 100 basis points for these kind of lending products. That is telling you inflation has not been covered. They have not finished the job, and it's going to put them in a rough spot, because now with their dual mandate, as unemployment starts to rise, with inflation rising, what do? And they have egg on their face, and they're in a really tough spot. And we'll talk about it again later, because I think you said we have a question about it, but I can show you where the big money's betting.